Hey everyone, it's John here with you. It's December 30th, about 20 after 9. We're going to do the second update of this week. As I told you last night, we'll be squeezing these two updates together since we have New Year's Eve tomorrow and then New Year's Day on Friday. So let's go ahead and get started. Please remember that no one here at Better Trades is any kind of registered broker, dealer, or investment advisor. And although we'll look at certain strategies and certain products that we'll trade those strategies on, does not mean I'm telling you to trade those particular strategies or those underlying products, whatever they may be. And nothing I'm saying here or showing here is to be considered any kind of advice about your own personal trading activity. So nothing that I say should be taken as any kind of recommendation. This is all for educational purposes only. And there's always a risk of loss in trading. Please keep that in mind, even when we were trying to limit risk. And lastly, I do not have any trading restrictions on myself, so I could be in some or all of these trades that we cover here in the Market Insights. Okay? So let's jump right into it. We're not going to have a real long update tonight simply because of the well, we have one position on now, right? Only one. We might put another one on, just a real short-term thing, something to play with. But what I'm going to do here is go over this particular trade. If you remember just last night, after the big run-up that we had, and I'll actually, excuse me, let me pull the chart up here. There it is. So, but we did have the big run up on the 29th, the big move up, and then we had today we pulled back quite a bit of that, 15 points actually. Pulled back almost the whole length of that candle. So, you know, what's tomorrow going to bring? We have no idea. But either way, the market did have a really good pullback here today, and what that should have done for us, if we bring back our not that risk graph, but give me just a second here, but this one here. But what that did for us is the call spread we sold yesterday, we talked about last night. We talked about the 2140, 2155 for $1.78 credit. Keep in mind that we sold the 2140 for $3.55 and bought the 2155 for $1.77. They gave us 15 points of risk on the upside, which is right here, because we're 15 points wide between 2140 and 2155. Now, if you remember last night, I think the profit in this was, if I'm remembering correctly, it was just like $112. I might be completely off on that, but I think it was like $112. And right now it's 243, so it's more than doubled from that pullback, because what's happened is when the market has pulled back, this short call spread that we sold right here has collapsed in value, and I'll actually show that to you. Keep in mind what the fill prices are, 355 and 177. But if we go in here and we just put in the current mid prices, it's only 88 cents, 192 and $1.05. So it's gone from $1.78 down to 88 cents. So it's dropped 90 cents, right? It's dropped 90 cents, and that's 90 cents profit we have made as that trade has collapsed from a value of $1.78 that it had last night down to 88 cents. Now the rest of the trade, the whole put side was put on for a for even money. Let me just get these filled back in here. There we go. So that's where we started from. So pull this up where we can see it a little bit better. So right there we are. And as we go forward a day or so, it's not really going to help us or hurt us as far as the time decay. And you can see where we are right here at 2063. So if we stay right there and we waste a few days here, all the way till Monday the 4th, we're really not being helped or hurt. That value of that trade's not changing too much if we stay right there. But if we do go on down some, you see the dotted line there, what starts to happen. So right now this trade's in really good position. It has exactly $243 in profit. And I know that's not a lot of money. There's not a whole lot you can do with $243, but look at it on a risk basis here of 38.22. Is there a risk? Now, how am I getting that? How am I getting 38.22? Well, keep in mind that on the downside we own a 2010 and we're short a 1990, so we own a 20-point spread there. So it's 20 points of income, and right here at 1890 and 1870 we're short 20 points three contracts. So that's 60 points that we're short minus the 20 points that we own right here. So that's 40 points of total risk, or what's really $4,000 in real money, right? So we took in $1.78 credit on that call spread. So all we're doing is we're taking $40 and we're subtracting from that $1.78, and that gives us $38.22, or what we see here as $38.22 on the downside. Okay, so that is our downside risk. Now our upside risk is basically 15 points minus the $1.78, because we're short a 15-point spread. So our risk is $13.22, and if you look, well, I can't get it right on there, but it should be $13.22. I can't get it right on there. It's like trying to split hairs, right? But 13. There we go, right there. That's our upside risk, and that would occur. We would take that complete that total loss on the upside, or the max loss on the upside, if we let the market come all the way up here from 2063 and blow through this 2140, 2155 spread and fall off this little, not too big of a cliff, but it is pretty steep. You see that? So we don't want that to happen. So if the market keeps heading on up very much, we'll do whatever we need to do to manage that. But right now we have $243 profit, and we're going to divide that by the downside risk. Keep in mind, you don't have to add your total risk together. We don't have to add together 38.22 and the 13.22. We don't have to add those together to get our total risk, because the market can't finish way up here and way down here. So really there's only risk on one side or the other, and we go with the greatest risk. That's how we calculate our risk, is where the greatest risk is, and here it's on the downside. So if we take that $243 and we divide it by the 38.22, that's exactly 6.4%. So that's not bad, considering we've just been in this thing, a handful of days. I don't have my charts pulled up, but I think this is like the fifth day or so we've been in this thing. Haven't been in it very long at all, and we've already got a 6% profit. Now, if we do continue to trend on down, which would be a really nice gift if that happened, we could see that profit really start to ramp up, right? And even if we could finish somewhere in here, which is not out of the question, we could sell on off and finish here somewhere between now and expiration. Now, expiration is the 22nd. It's several days away, but if we finish in here at 2178 profit, and keep in mind that $2,000 is coming from this 20-point wide spread being in the money, or 2010 1990 being in the money. So if we finish anywhere between 1990 and 1890, we'll make that $2,000 plus the $1.78 credit. That's where we're getting that 2178 from. You see over on the right hand side in red. So I'll just tell you straight up right now, there's nothing wrong with taking this trade's profit, shutting it down for 6%. We've been in it about a week or so, and we could take the rest of the month off if we wanted, or go look for something new. Now we'll hang on to this one a little bit longer, because this is an educational platform here, and we're trying to learn as much as we can. So maybe if the market goes on up or comes on down, we might see some of this profit disappear if it goes on up, if the market hits on up. But for the time being, we want to use this time to educate ourselves and learn as much as we can about managing these things, because it doesn't always go completely smooth all the time. So we'll hang on this a little bit longer and see what it brings. But just keep in mind, right now it has over a 6% profit, and if we could do that every month, that's it's 40, or I'm sorry, that's 72% in a year, non-compounded. So that would be really good. So that's all we're going to do with this position. Let's just leave it in place, and we can come in here and look at our stats. Our delta slightly negative, and that's obvious, and that should make sense to you that this delta is negative, because when you look at the graph, how does the trade benefit the most right now? It benefits if the market goes on down in value. See that? It benefits if the market goes down. So we're carrying slightly negative delta, and so if the market goes up, it's really not going to hurt us, especially as time passes. It's not really going to hurt us, but if it goes up too much, then we might be concerned. But on the downside here, you can see that negative delta is really our friend, right? So, and more important than that, this is the theta trade. You look at that theta trade; it's almost 13. So we're in good shape there. Typically, I mean, this is a one contract example. Typically, I like to have the theta at least 10. If you have to have an area you want to keep it at, I'd like to have it at least 10. And Now, if the market falls down in here and time starts passing, it's going to get a lot bigger than that. But if this starts dying off right here, that theta starts dying off, I'd probably do something like roll these short spreads up. These 1890, 1870s, roll them up and take in some more credit. That will jack that theta right back up. Another way to jack the theta up is you could sell out this long spread that you own the split, and you could sell that spread out. We're not ready to do that yet. There's still too much time left in this thing, and plenty of time for it to go on down, which is what we hope happens. But right now, just keep in mind that there's a very good profit in it, 6% and over 6%, almost 6.5%. So we're pretty happy with this trade right now. Okay, so something else I thought we might do for fun here is look at something for tomorrow, and let me see here. Just give me a moment. We don't have an expiration tomorrow, do we? I thought we did, but we do not. Well, it looks like the next expiration is January the 8th. Okay, so what we could do here is we're looking at January 8th expiration, and if we go in here and look at this, the market right now is at 2063. So let's say that we put on a, well, actually, let's go to the chart first. Let's pull up the chart and take a look here. So if we could put something on for next week where the support, we've got a little bit of support right around here, around 2040 or so. If we could get below that and put on something for a decent credit. Now this is something that we're just going to do a one contract lot of and just sort of do for fun and help us learn a little bit. So this expiration's next week. So if we could come down here to the, let's look at like the 2040, 2020, 2000. Okay, now that is an equidistance 132 butterflies. The way I have that set up, buying one of the 2040s, selling 3 of the 2020s, buying 2 of the 2000s, and let's see what that's going for. That's going for 90 cents. Okay, that's going for a 90-cent credit. So what we could do here is we could put something like this on. Now here's what we're basically doing. We're buying one contract of a 2040 put, and the market again is right here at 2063. We're buying one contract of a 2040 put. We're selling 3 of a 2020, and then we're buying 2 of a 2000. And this thing has 20 points of risk. And the way you figure that out, it's actually very simple once you get used to it. But the way you figure that out is the one contract that we're long here that we own between 2040 and 2020. That's 20 points wide. That's that slope right there. So we own 20 points there, and then we're short 20 points between the other 2 shorts. Remember, we're short 3 here at 2020. We're short 2 more in addition to the one that's paired with the 2040 put. We're short 2 more 2020s that are paired with the 2000. So that's 20 points times 2. That's 40 points of risk on the downside. So overall, it's 20 points. Now the easiest way to look at this, if you're looking at any 132 butterfly where the strikes are equidistance apart, all you have to do is look at your long spread. How big is your long spread? It's 20 points from 2040 to 2020, and that's how much risk the total butterfly has in it. It's the same amount that your strikes are apart between 2040 and 2020. So here, this trade has 20 points of risk, and you can see that if we come down here and look at our max risk, it is at 1910. Now why is it 1910? Because we're taking in 90 cents of credit. So it's $2,000 minus 90 bucks basically, because we're taking in 90 cents of credit. So we could put this on after this big move we had down today. We could put this on as a credit trade, where we're taking in a credit for it, and it expires next week. Now a lot can happen in the next week. We all know this, right? But this expires next week. But what you can see here is if we start going forward, even till just Monday, which is the 4th, right? So if we can just get through tomorrow and then to Monday, there's the 4th. You can look here. I mean, even if we're still sitting up in here, look at the profit that we'll have. Almost $200. Almost $200 based on $2,000 risk. That's almost 10%. Now, the question then becomes, well, what's the risk? Well, there's no upside risk. There's no danger to the upside at all. If we do nothing else and the market goes up, we could sell back our long spread here and let the trade expire and just keep whatever credit we have. So that's one thing we could do. The other thing we could do is not do anything if the market goes up, just let it expire. Or we could let that theta burn some, and even if we go forward to the 6th or the 5th, you see how our profit really ramps up here. You know, I mean, all through here from, you know, about 2040 all the way up to 2075 or so, we're keeping somewhere around $200 profit. That's about 10% in a week. So the real risk, or the only risk, is if the market just falls apart and crashes. Now, if that would happen, what we could do is come in here and buy we could do a couple things. We could butterfly off the short side of this spread by buying like a 2020, 1995, maybe 1985. We could buy a butterfly like that, and let me just show you what that would look like. So we're saying if the market crashed on down, we could do a 2020 and again it would have to be two of them because we're short two on this credit side. So we do like a 2020, 1995, maybe a 1985. Okay. And so what we're going to do here, and we would do that on a 2 by 4 by 2. So we're buying 2 here, we're buying to close these two at 2020. We're selling 4 here at 1995, which is right behind our long 2000, and we're buying 2 more at 1985. Let's see what that would look like. There you go. You see that? So basically we still own our 2040 20 put spread right here. And then we butterflied off the rest of it to where right there's our long 2000, there's our short 4 contracts of the 1995, and there's the long 2 of 1985. Now, if you look at the downside of this after we butterflied it off, it's all in the green, and it's like that infinity the rest of the way down. So it's all in green. Now, that will not be the case if we would crash and have to make this adjustment next week sometime, because it's going to be much more expensive to make that adjustment, right? Much more expensive. So, you know, although it looks really good right now, it's not going to look as good if we have to make that adjustment next week. But that's something that we can we can talk about when and if the time comes. So what we'll do is let's put this on as a practice trade for 90 cents. Now obviously in reality, I get up tomorrow morning and the market's going down. If I'm looking at this here tonight and I get up tomorrow morning and the market opens down 10, 12, 20 points on the SPX for whatever reason, I would actually adjust these strikes and move the whole butterfly on down by 15, 20 points, move the entire thing down further, lower strikes, and still take in a nice credit here for it, right? But here in this trade, if we were just to put it on right now, we could put this one on for a 90-cent profit. We have a nice healthy theta of 19, so our theta is really good. Our delta slightly positive, which makes sense because we see that the trade immediately benefits if the market starts going up. Right, it immediately benefits starts going up, so it makes sense to have a little bit of a positive delta there. And so let's do this as a practice trade. But remember, if the market would head down, our adjustment would be a 2020, two contracts, a 2 by 4 by 2, a 2 by 4 by 2, 2020, 1995. That's where we would sell for, is at 1995. And then maybe buy 2 at 1985. That still leaves some downside risk, which can be cleaned up later if the market keeps heading down. But there's no need to completely balance off the downside. We can leave a broken wing on the downside and have that tail pulled a little further away. And if we need to clean the risk up later, that's fine. But what we have here is we do have 20 points of income that if the market gets through this, we have 20 points of income to help pay for that. And we can go ahead and box that in with a call spread. Maybe doing like a 20-20, 20-40 call spread, buying that call spread and boxing that in. So let's put this on for fun and see how it goes. I think this will be something good for us to play with and learn from. But like I said, I mean, if we just make it through tomorrow into Monday, which is the 4th, is that right? Yeah, Monday's the 4th, or even Tuesday. I mean, boy, look at that. I mean, wouldn't that be nice to pull, $250 out of a trade where you only have 1910 risk? How much would that be? 250 divided by 1910. That would be a 13% return, just basically in no time at all. So we'll see. We'll put this on and see how it goes. But that's all I have for you here tonight, folks. We're gonna go ahead and call it quits, and I will see you all early next week sometime, probably Monday. And we'll take another look at this and their other current trade we have on now, which is also good and profitable, 6% in just a handful of days. So we'll do that. Something else that's nice here on the analytics program is it shows the break even up and down on the over here in the some of this data. The max risk is 1910. It shows that, which we can look at here on the risk graph, but it shows it for us what the max risk is, and the max profit is 2090. Where is that max profit reached? It's reached right there. If the market would finish right at our shorts, that's where that max profit of 2090 is reached, that we're seeing right over here. It's reached right there, because if the market finishes right here at 2020, that will give us our max profit of 2090, because our 2040-2020 one contract, or that 2040-2020 spread, that one contract that we own will be completely in the money. That's $2,000 plus the $90 credit. That 90 cents is $90. So that's why we get that 2090 max profit, right? So real neat to see those things both mathematically and graphically. So you really need to get used to learning them both ways. But that's a real cool feature of this program. So folks, that's all I have for you. We'll call it quits. Everyone have a great new year. Be safe, have fun, and I'll catch up with you early next week, and we'll see how things are going. You all take care. Bye-bye.